It's important to know what's happening with your money. And as you research investments, you might hear suggestions to use things like mutual funds, ETFs, and index funds. People often use those terms interchangeably, so that could make you wonder what's the difference and why does it matter, and are you using the right tools as you invest for the future? So that's what we'll cover for the next couple of minutes here. We'll compare and contrast the features of mutual funds versus ETFs versus index funds for the average investor. That might be somebody with several $100,000 saved for retirement, and most of that money is in retirement accounts like IRAs or a 401k. So let's talk about some similarities, because ETFs and mutual funds are very similar. In fact, they share the same underlying structure as open-end investment companies as defined by the SEC. Now, really, what they do is they make it easy to spread your money among many different investments by using a single investment. And for a lot of people, it might not really matter which one you choose, but there are some key differences that we're going to get in later, which might actually be important to you. So a fund is a pool of money, and for most people, that just means it's a pool of money that's going to buy stocks and or bonds. And each fund has an objective. So that might be to purchase investments of stocks in the US or overseas stocks, etc. As an example, let's say you want to invest in lots of different US company stocks, let's say 500 of them. Well, if you did that on your own, you would have to place 500 different buy orders, and that's of course after picking which 500 stocks to buy. But with a mutual fund, you can easily get all 500 of those or exposure to something similar to that with one purchase. These funds can have a variety of different objectives. So it might not just be US stocks, but it could be overseas stocks. It could be certain sectors of the stock market like technology or healthcare. It could be big or small companies. It could also be fixed income investments like different types of bonds, such as corporate or government bonds or junk bonds. You can invest in lots of different things. There are also single fund solutions. So you would just use one fund to get access to a fully diversified portfolio, possibly with stocks and bonds. That might be a balanced fund or an asset allocation fund or a target date fund. So ultimately, you can build a portfolio with whatever level of risk is right for you and with whatever components you want the most. So whether you use mutual funds or ETFs, you can accomplish that. But there are also some important differences. A critical difference is how you trade. So when you buy a mutual fund, you purchase these newly created shares from the fund issuer, the fund sponsor. Then when you sell that to get your money back, the fund sponsor will redeem your shares. And of course, the value may have changed between the time you buy and when you sell. With ETFs, on the other hand, you're trading in the open markets for the most part. So you're buying and selling from other market participants, and they trade just like stocks. A few things to know are that mutual funds typically only trade at the end of the day. So that's at market closing, which is 4 p.m. Eastern on most business days, versus ETFs can trade throughout the day. That's also known as intraday trading. Again, just like a stock, you can buy and sell at 10 a.m. or 1:30. The units that you trade are also different. So for mutual funds, you can trade in either dollars or shares. So for example, you can say buy $2,500 or sell $1,000. That's an easy way to trade and get some money out for income. You don't need to worry about what exactly is the share price and do any calculations. But with ETFs, again, they trade like stocks. So you're going to typically trade a number of shares. You might pick a certain number of shares that you think will get you near what you want in dollar terms. But you don't know the specific dollar amount until the order actually gets executed. So that can introduce some uncertainty. Now, some platforms are making it easier to trade ETFs. You can do partial shares or maybe even request trades in dollars, but mutual funds are traditionally easier. Mutual funds are also easier when you want to automate things. So again, let's say you're saving $1,000 a month, or you're taking $2,000 a month of income in retirement. That can easily be automated with mutual funds. You can schedule buys and sells, and then you can pair that with a bank transfer. So You can sell $2,000 of a mutual fund and then move that money over to your bank every month without ever logging into your account. That just makes it really easy. But with ETFs, you can't do that type of automation, at least not today. So you would need to log in and enter a trade order, and then you can zap the money over to your bank account. Because those ETFs trade like stocks, you also need to know about order types. So do you want to enter a market order or a limit order or use a stop somewhere? These are all things you need to figure out and understand if you're going to trade ETFs. But with mutual funds, you don't worry about any of that stuff. You just enter an order and it executes at the end of the day. When it comes to trading costs, there could be some differences. Now, when you enter a mutual fund trade order directly with the issuer, let's say you're trading a Vanguard fund at Vanguard, there's typically no transaction fee. That's the case with most no-load mutual funds. Other mutual funds may have loads or sales charges, but if you're trading a no-load fund directly with the sponsor, there's typically no fee. But if you trade a different company's mutual fund, you may have to pay a transaction fee. For example, if you're going to trade a Vanguard mutual fund at Fidelity, they might charge you a transaction fee. So it's important to consider whose funds you want to use and where you have your accounts as you decide how to invest. When it comes to those ETFs, again, they trade like stocks, and a lot of the brokerage firms these days have no transaction fee trading on equities. So you would not generally pay a transaction fee to buy and sell ETFs. But again, you have to confirm all of this with a broker at whatever vendor you use, whatever custodian you use. You want to confirm all of this before you make any decisions. Next, we have minimums. So mutual funds might have a minimum initial purchase requirement. They might say in a taxable account, you need to start with at least $3,000, or maybe it's only $500 in an IRA, versus an ETF, which maybe you just have to purchase one share, or even you can buy fractional shares in some cases, so you don't even need to come up with that much money. Now, if you do use a mutual fund that has a minimum requirement, and not all of them do, by the way, there are some with zero minimum requirement, but if there is a minimum requirement, you can always just build up cash in your account before you make that initial purchase. That might delay things by several months. But if we're thinking in terms of long-term investing over decades, that doesn't necessarily hurt you too much. That said, it always feels good to get momentum, so keep that in mind as you explore your options. So that was a little bit on the mechanics of trading these, but now let's get into the ongoing costs that you might face with mutual funds versus ETFs. The costs can be all over the board. You can find very inexpensive mutual funds, very inexpensive ETFs, and you can also find expensive mutual funds and ETFs. So one type of vehicle isn't necessarily better than the other. I suppose ETFs sort of have a reputation for being low cost, but that's not always the case. It's important to know that some mutual funds have additional expenses beyond just the annual operating expense. So there might be sales charges or loads. There may also be 12b1 or distribution fees. All of those expenses are things you want to look at and evaluate if you're going to buy mutual funds. So let's look at a couple of examples here just to paint the picture. And I don't recommend that you buy or sell or hold or use or don't use any of these funds. These are just examples of some of the better known funds that you might come across in your reading. So I wanted to paint the picture with these. We have a mutual fund first. This is the Vanguard Total Stock Market Index Fund. And we're going to compare that with VTI, which is a Vanguard Total Stock Market ETF. As you can see, the expense ratio is pretty close between these two. The mutual fund is slightly more expensive. If you use that one, I don't think this is going to make a huge difference in your retirement, but the larger your account balance is, I guess, the more this might start to matter to you. But in either case, these are both pretty inexpensive funds. We've also got the Fidelity website here, and looking at the Fidelity Total Market Index Fund, that's going to be very similar to the other two. You see that it's got a pretty low expense ratio as well. But if we type in that VTSAX, and let's say you wanted to trade that over at Fidelity, You might have noticed it said no transaction fee on the previous page with the Fidelity fund, but now you see that if you trade a Vanguard fund over at Fidelity, they are going to charge you a modest transaction fee. So moving on from costs, let's look at some market factors. And this is going to apply primarily to ETFs because, again, they trade like stocks in the markets, and you're not just buying and redeeming shares like you would within a mutual fund. So with ETFs, you can have distortions throughout the day. So you might expect the price of an ETF share to perfectly match the total cost of everything that's inside of it, or the net asset value. And that's not always the case. There are times when the price of the share for the ETF is actually a little bit higher or a little bit lower than the total value of the underlying holdings. You've also got a bid-ask spread with ETFs. So the bid is what buyers or potential buyers are willing to pay for a share versus the ask is what sellers are asking buyers to pay. That's what they're demanding before they're going to release their shares. And sometimes there's a gap, and it's often quite small, especially with really popular and with ETFs that trade a lot. But if you're talking about thinly traded ETFs, those that aren't that popular, kind of esoteric, or if there are extreme market movements, maybe there's big news that day, you can have a bigger bid-ask spread, and that can introduce a cost, whether you're buying or selling. If you're concerned about those things, the ways to maybe reduce the impact of distortions and the bid-ask spread might be to trade during the day. So maybe not right at the opening or closing of the markets, and maybe consider not trading during major news events. So that's when these distortions can be the biggest. And of course, if you use these really popular ETFs that have a lot of volume, you're probably going to have fewer problems. Now, you can't eliminate these problems altogether. Those are just some tips on possibly mitigating those challenges. But again, things can happen in the markets. If you're trying to figure out how these might affect you, contact a broker at your custodian and ask them to talk things through with you. Ask them for some coaching on when and how to trade ETFs. Next, we get into taxes. So ETFs can sometimes be more tax efficient. The way they're structured allows them to possibly kick off less in terms of distributions that are going to end up on your tax return. Now, that only matters in taxable accounts. So if you have your money in an IRA or a 401k, then the tax treatment doesn't really matter. But if you have significant assets in taxable accounts, that's like a joint or an individual account, for example, that's when you might care about the taxation. That said, this could change in the future. So, for example, Vanguard had a structure where their mutual funds were very tax efficient, and they had a patent on that structure, but the patent ended in 2023. So we might see other mutual fund companies copying that. I don't know if we will or won't, but basically, you want to keep in mind that mutual funds might get more tax friendly relative to ETFs in future years. And once again, that's not a recommendation to use or to avoid Vanguard products. It's just information about how one firm has been innovating. And, for a lot of people, again, the people with most of their money in retirement accounts, maybe a couple 100,000, this isn't going to make or break your retirement or impact whether or not you can afford a private jet. But for people who have a lot in taxable accounts, it could be interesting. Now let's talk about index investing. So both mutual funds and ETFs are available in index versions. I don't see any clear advantage to choosing one over the other if the main priority is to index. If you're not sure what indexing means, it's basically passive investing, which involves buying a number of investments without selecting individual securities. If we put that another way, you essentially buy the whole market instead of picking individual stocks or individual issuers. And the idea is that the rising tide will float all boats, and you'll get some exposure to the winners, and the losers won't hurt you too badly. And instead of trying to make bets based on what you think will outperform or underperform. You just buy the whole market and relax. The term passive might strike you as negative. You might be trained to think that effort and being proactive is a good thing, and that's what brings results. But that's not necessarily the case in investing. So we might use the analogy of a burning building. If you're in a burning building, you say, don't just stand there, do something. But with investing, you can often say the opposite, which is don't just do something for the sake of doing something, stand there. Just wait for the markets to do their things. Let time work for you, and that often works out well for long-term investors. There's no guarantee that things will pay off for you, but it's often a reasonable strategy. So there are a couple of advantages to index investing. One is cost. So without active management, you're not paying for managers, you're not paying trading costs, and the cost of a mutual fund or an ETF is one of the most important determinants in its performance. So with indexing or passive strategies, you generally have the lowest costs. Tax efficiency is another biggie. So if you don't have active management and instead you're just sticking with an index which doesn't change very often, then you're less likely to have unwanted tax consequences and surprises, but anything's possible. And performance is important to everybody. So those index funds generally follow more or less the index that they're designed to follow. So they aren't going to make big bets on anything that might not pay off, which could lead to significant underperformance. Instead, they just more or less follow the market. So you're not necessarily going to outperform. You're not trying to do that. But if you believe in, let's say, long-term growth of the markets, then you can participate in that growth with index funds. You are, of course, along for the ride. So when there are losses, when there's volatility or downturns, you participate in that as well, but that's also the case with active funds. The research shows that index funds have very respectable performance, especially over the long term. So over a short period, sure, some actively managed fund or you picking stocks might beat the index. But over long periods, let's say 5 or 10 years plus, an indexing strategy appears to be a very good strategy to follow. For example, we can look at data on how many actively managed funds outperform the S&P 500. So these are large cap funds that would, more or less compete with the S&P 500. How many of them outperform the S&P 500? And over 1 year periods, yes, it happens to some degree. As we extend that out to, let's say, 5 years or 10 years or more, the percentage of actively managed funds that outperforms drops significantly. So you are really, helping yourself if you stick with a primarily passive strategy. So what is an index? It's just a grouping of investments, let's say stocks that meet a certain criteria. So you might say, of all of the liquid stocks in the US, we're going to call that the Wilshire 5000. Or if you want to say 500 of the biggest, the leading stocks in the US, that's the S&P 500. So they meet certain criteria, they fall into this basket, and then some mutual funds will attempt to follow that basket. Now, you can't invest directly in an index. Again, the index is the grouping, and the vehicle to invest in an index fund is either let's say a mutual fund or an ETF. So there are always going to be some fees that cause your performance to diverge from what the index does. And there's also tracking error just because the way they construct these things might not match it exactly. But the idea is to get you as close as possible to a particular index. So for a very simple example of how you might invest with index funds is a 3-fund portfolio. And with that model, you might use a total US stock market fund, you might use an international index fund, and you might use a fixed income index fund. And of course, you could add other things as well. And the proportion that goes into each one of those funds is going to depend on your appetite for risk, how much stocks versus bonds, as well as other factors. There's a lot more we could say about indexing, but now isn't the time for that. The general idea is that indexing equals passive, and it's available whether you use mutual funds or ETFs. So which is best as you choose between mutual funds versus ETFs versus index funds? Well, let's start by saying, do you want to keep it simple? And if that's the case, often mutual funds are a great choice. That's because you can automate things. You don't need to log in regularly and do stuff with your account. You can just set up certain purchases or sales and then let things run on autopilot. That's the easiest way to invest. If you're tempted to trade, like you see certain news items and you want to go and make a purchase or a sale based on that, that might also point toward mutual funds because they're only going to trade at the end of the day. That puts a little bit of space between you and the impulse to trade. Even if you enter the order, you might be able to cancel it later. Again, check with a broker, but the mutual funds might encourage long-term investing versus ETFs, which might encourage more active trading. If you have sizable assets in taxable accounts, that might point towards ETFs. Again, I'm not sure how much you're going to gain, but you want to at least look at that and decide, does it make sense to use ETFs for the tax efficiency in those taxable accounts? And indexing is often a good strategy. That enables you to more or less match what the underlying markets are doing, and then you can dial in the risk level and the allocation based on your preferences. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you and take care.